Hi, this is Sylvia from IFRSbox.com and you're watching the video about compound financial instruments in line with IAS 32. So you'll learn how to account for convertible bonds and other types of instruments that contain some liability and equity elements. This explanation, together with example, is a part of a very intensive course about financial instruments in line with IFRS that will lead you through this extremely difficult area in a human language so that everything is clear after you finish watching the course. So in this course, you will learn also about the standard IAS 32 on presentation of financial instruments, and you will specifically learn how to distinguish between equity instruments like issued warrants and liabilities, because sometimes it's not that simple. One of the most difficult issues in classifying liabilities and equity instruments is compound financial instruments. What is it? It is a financial instrument that contains both a liability and equity element. Typical example is a convertible bond where issuer or borrower issues a bond to the holder or lender, and the lender has an option to get the bond repaid by ordinary shares of issuer instead of getting paid in cash. So here there are two elements. A liability element is a conventional loan or bond because the issuer has the liability to settle it with a transfer of some cash or a financial asset. The equity instrument here is a call option written to the holder to convert the debt into a fixed number of the issuer's common shares. In this case, IAS 32 requires to classify and present these two elements separately. So the loan element is shown as liability and the equity element as equity. Well, how to do this? First, it is necessary to set the fair value of the compound instrument as a whole. Here, we would set the fair value of convertible bond. It should not be that difficult because if a transaction happens under the market conditions, then the fair value equals to proceeds received, well, in most cases. Secondly, the issuer would value the liability component, which is the bond with the same parameters as the convertible bond, but without the option to redeem in shares. The last step is to calculate the fair value of equity component as a difference between the fair value of the compound instrument as a whole, in step 1, and the fair value of the liability component set in step 2. Well, this is so-called with and without method, and although there are more methods of splitting the equity and liability component, this one is probably the most common. The split between equity and liability is performed at the time the instrument is issued and is not subsequently revised for the changes in interest rates or other items. Now let's take a look to our example. Razor plc decided to raise cash by issuing 5,000 convertible bonds in the beginning of 2003. The bonds have 5-year term, are issued at par with a face value of 1,000 per bond. The bonds carry the coupon rate of 4% per annum, and coupon payments are payable annually on 31st December each year. Each bond is convertible into 300 common shares. At the time of issuing the bonds, the average market interest rate for similar debt without option to convert into shares is 7%. The risk-free annual interest rate is 3.5%. Advise Razor on how to present these convertible bonds in the financial statements at the time of their issuance and show appropriate journal entries. Well, first of all, we need to set the fair value of the convertible bond as a whole, which is in fact equal to the proceeds from the bond. So the bonds were issued at par, and it means that Razor received 1,000 for each bond, because at par means equal to nominal or face value. Face value of bonds is 1,000. Razor issued 5,000 bonds. So total proceeds from these convertible bonds is 1,000 multiplied by 5,000, and it gives us 5 million. And that's the total fair value of the compound financial instrument as a whole. Now we need to split this into equity and liability component. So now let's value the liability component. we need to set the fair value of the bonds with similar parameters, 5 years maturity period, the same coupon of 4% paid annually, but without the option to redeem the bond in shares. The question says that the average market interest rate for similar debt without option to convert into shares is 7%, and the risk-free annual interest rate is 3.5%. So what rate do we select? Well, in reality, you should look to market yields for the similar instruments and not risk-free rates, because we look for fair value of similar instrument. And so we select the rate of 7%. Then we are going to calculate the present value of cash flows from the similar bond. So I drafted a simple table here. The first column is year, because we will need to know the cash flows each year. The second column stands for coupon payments. These are simply payments of fixed interest at 4% on 31st December each year. Well, please do realize the difference between coupon and market yield. It's not the same thing. While coupon payment is fixed payment basically, market yield is the real return of the investor from the bond, taking bond's acquisition price, coupon payments, and other factors into account. So each year, Razor will pay 5 million times 4%, which is 200,000 per year. Also careful here, because if the coupon is repaid twice a year, then I recommend to put each period of repayment into separate line, so you would have one line for June and one line for December coupon payment. And don't insert two coupon payments on different dates into the same cell, then the formulas would not work. In the next column, we have the repayment of principal. As the principal would be paid after 5 years at similar bond, it is 5 million in the last year only. And in the next column, we can calculate total cash flows as the sum of coupon payment and principal repayment. Then we need to calculate discount factor at 7% for each year of cash flow using the formula, this one. Let me just insert it here. And the present value of individual cash flows is our discount factor multiplied by the cash flow in individual year. Right, just copy it to the other lines. Total of present values of individual cash flows gives us fair value of the liability component of the convertible bond, right? Which is 4,384,970. Now, if you want to shorten this calculation, it is possible by using simple discount factor and annuity formulas, but I prefer this table form because you can use it in practically all circumstances, even when cash flows are not the same each year, like here. But let me show you the shortcut for this situation. We need to calculate the present value of principal repaid after 5 years. As it is just one single payment, we will use simple discount factor formula shown here in this rectangle. And we will multiply the principal repayment of 5 million with the discount factor. And the present value of the principal at 7% is 3,564,931. Then we need to calculate the present value of coupon payments. Each coupon payment amounts to 200,000, which is 4% of 5 million. It will be paid annually at the end of each year. As we are dealing with regular payments now, we can use the formula for annuity, shown in another rectangle here, right? We can multiply the annuity factor with the amount of regular coupon payment, and we get total present value of 5 coupon payments amounting to 820,039, right? Adding these two numbers, we get the present value of a liability component equal to 4,384,970, exactly as in our table calculation. So apparently the formulas work. Now, we can calculate the carrying amount of equity component of the convertible bonds, which is in fact the call option to shares. It is calculated as fair value of the compound instrument as a whole, 5 million, less fair value of the liability component, 4,384,970. And we get a fair value of the equity component of 615,030. So now when we split it, the equity and liability component, we can draft our journal accounting entries. We debit cash or bank account or some receivable account, well, depending on how Razor gets paid for issued convertible bonds with 5 million, because it's the cash received. We credit liabilities, convertible bonds with 4,384,970. And we also credit some equity accounts, convertible bonds, with 615,030. Yeah, and that's it. We have splitted the compound financial instrument into equity and liability components. So, if you'd like to learn about other issues related to financial instruments like derivatives, hedges, embedded derivatives, effective interest methods, setting the fair values and others, it's all covered in our online courses. You're welcome to subscribe for free IFRS course on IFRSbox.com and learn the basics of IFRS. Bye bye and thanks for watching.